Hello, active traders, and welcome to our special event tonight. Tax reform tips from Robert Green, CPA from Green Trader Tax, and Breakouts with me, Ken Calhoun from TradeMastery.com. Bob, it's great to have you with us here tonight.
Thanks, Ken. It's great to be here.
Let me introduce Bob and read our quick disclaimer. As always, all information is for educational use only. We're not making advice about what to buy, sell, or hold. By watching this, you agree not to make actual trades. It's all for information use only. Really pleased to share the stage with Bob Green. I'm not just a colleague, but I'm a customer and a thrilled client of his company at www.greentradertax.com. Bob Green's well known as the world's top authority for trader taxes. He's been in CNBC, Bloomberg Television, Forbes.com Video Network. He's also a speaker at the Money Show events. Highly respected as the world's top CPA for trader taxes. So with that, let me go ahead and turn it over to Bob, and we will get underway with tonight's event. Bob will do the first 30 minutes, and then I'll bring up the last half hour with breakouts in our current market. So with that, let me turn it over to Bob, and we're good to go.
Thank you very much, Ken. Let's get started. Tax reform should be good for traders. Congress, President Trump, they want to do tax reform. They're trying to get health care done first. And it's probably going to be a really good thing for traders, and you should support it. I'm the managing member of Green, Neuschwander and Manning, LLC, and CEO of Green Trader Tax. We focus on traders. Thanks for reading or going over my bio, Ken. And you'll see us in all the major media. And I saw your disclaimer. This is not one-on-one tax advice, just general advice. I encourage people to work with us. And we're not affiliated, Ken. You do trading education, we do taxes, and we're separate companies. Tax reform proposes lowering tax rates. So that's across the board. That should be good for everybody. Lower rates. Especially on business and investment income. President Trump really wants to give lower rates on business. And the House wants to keep lower rates on investment income. And we all know that's really long-term capital gains, qualified dividends, but they seem to be slipping in short-term capital gains and interest too. That's almost too good to be true. Now, they do repeal itemized deductions for most categories. They keep it for mortgage and charity. So investment expenses are repealed. A lot of traders don't have a lot of investment expenses, but active traders who make a living, they get business treatment. So again, you're in the business category and you get the golden goose, even more so with the Republican tax cuts. They favor business. They favor investments. So remember, for most traders, their investor tax status, they're stuck with those investment expense deductions, which are going to be repealed. There's a capital loss limitation of $3,000 against other income. There's wash sale loss limitations. There's no opportunity to deduct health insurance, a retirement plan. They're very constrained. Now, 1 or 2 out of 10 traders may qualify for trader tax status, and we have a lot of content on that. That's the 4 trades a day, 4 days a week, and a lot of other factors. Trader tax status is the linchpin under current law, and it should be under tax reform law for using business expense treatment, making a timely 475 election to be exempt from the capital loss limitation, to get full business ordinary loss treatment, and to be exempt from wash sale losses, and to arrange the health insurance, retirement, the health savings account, and other employee benefit plan deductions. It's only going to get better with the tax reform proposals. I call it TRP, tax reform proposals for favor traders. First, it favors expensing even more because they figure businesses create jobs. It's a jobs bill. We don't expect tax reform, TRP, to deny trader tax status. There's been no indication of that in any of the proposals, which of course are lacking in details, but that's not the direction they're going. TRP favors full cash expensing. That accelerates deductions so you don't have to do depreciation, depletion allowances, amortization. You get it up front. Well, traders mostly have it up front now with Section 179 intangible property expensing. So there's not a big change there. TRP does not reduce trader expenses, and in fact, it may expand them. So I think we're looking good now, and we should do even better under tax reform. TRP does not mention changes to Section 475, the tax loss insurance. In 1997, Congress recognized TTS traders by expanding 475 mark-to-market, ordinary gain or loss, that's that tax loss insurance. It expanded it from dealers to traders in securities and commodities. There's been no word that they're going to repeal or do anything with 475. They're not going to boot traders or reverse course. TRP, in fact, favors expanding MTM. They love MTM. Especially Chairman Camp in the 2014 tax reform proposal wanted to have MTM on derivatives, including equity options. After all, that leads to tax simplification. A lot of traders now trade complex options trades, and they have offsetting positions, could be a four-legged position. It can get very confusing with wash sales, straddle rules, offsetting positions. It would be a lot simpler to use MTM because the realization method is very complicated. If they go to MTM for everything or allow a stock trader to use it for everything and don't make it jump through hoops for the 475 election and trader tax status and give you ordinary gain or loss, and anyway investment income is partially excluded, that's a good world to live in. MTM is a good world for traders. And of course, we want to keep that tax loss insurance with MTM. Now, TRP doesn't fix wash sale loss problems. MTM can fix it, but they don't address the wash sale loss problems. And it's a question whether we should try to push Congress to deal with this wash sale loss problem. I think most CPAs and the IRS don't even realize that this problem is brewing, which our clients know about. TRP does not address the wash sale loss problem where the broker rules differ from taxpayer rules. Broker 1099-Bs are based on identical positions per account, and that differs from the taxpayer rules on Form 8949, where it's across all accounts and substantially identical. That's not addressed. I don't know if there's a good solution there anyway. I just hope they get rid of wash sales more with the MTM rules. And of course, MTM is unrealized gains and losses or taxable income, just like with futures, 1256 contracts. But if you're a day trader, you don't have open positions at year end anyway. Now, this is important. TRP has indicated that they want to repeal NOL carrybacks. Now, under current law, a taxpayer may carry back net operating losses 2 years and or forward 20 years. This has been fantastic for green trader tax clients. We've had clients lose $500,000, $1 million, millions of dollars. They could be very profitable for many years, but then they just hit the skids in a given year and they lose a lot of money. They don't want to carry forward a capital loss carryover. They need that tax refund right away. So repealing NOL carrybacks is really going to negatively impact traders. It's not enough to just allow them to carry it forward. Small businesses count on, including traders, on an immediate NOL carryback tax refund to replenish their activities to retain jobs. Repealing NOL carrybacks is a job killer. It's going to make people shut the business doors. They need that refund check immediately to stay in business. Traders need it to replenish their trading account. And we've communicated this through various groups to the tax writers. My partner, Darren Neuschwander, to his credit, really pushed that point with his AICPA task force, who was directly involved in lobbying the government on all this stuff. So thanks to Darren on that. Lower 15% tax rate on business income. This is the cornerstone of the Trump tax cuts. When Trump said corporations should pay 15%, not 35%, wow. I mean, that's just a little bit more than Ireland and some of these tax havens. It's on par with Germany. You know, a lot of these countries now have been, corporations, global corporations, do country shopping. They pick a country to put their headquarters or inversions, operations, subsidiaries, where they can pay the lowest tax rates. It's sort of like states in America that try to win over GE or Aetna that are leaving my home state of Connecticut. So that's an incredible rate to put on the books to attract people as a tax haven in America. Now the House is talking about 20%. It's going to be tough to get that. So whatever it is, it could be a sizable reduction. Now most small businesses operate as pass-through entities. They are very aware of that. All of them respect that. So they want that rate on LLCs and S Corps too. But then of course, because otherwise a lot of small business will just convert to a C Corp. So they got to work out the particulars. There's a lot of grounds for abusing that. There are no details yet with the lower business rate. Will it apply to only retained earnings that stay in the company that you use to pay out jobs? If you're taking the money out of the company and paying 15% rather than the top individual rate of 39.6%, you're kind of gaming the system and not hiring more people. Now, TRP mentions that PTE should have reasonable compensation. You can't make $500,000 in your S Corp, pay the 15% rate. They're going to want you to have reasonable compensation, which they want for, let's say, a software business S Corp now who avoids payroll taxes. So we'll see what the details are, but the key point for traders, this is the key point. Will the TTS trading income qualify for the lower business rate? A TTS trader with Section 475 MTM ordinary trading income, they have ordinary income on their S Corp or LLC partnership return. That looks like other types of business income tax returns. Now, hopefully that's going to qualify for the business tax rate. But keep in mind, technically it's not business income. It's trading ordinary income. Business treatment applies to the expenses, not really the trading gains or losses. Now, TRP is more likely to exclude a TTS trader with capital gains income that doesn't use 475 because that shows up as capital gains. So you got your entity, you got your trading gains, you got your business expenses. Will you get the lower business rate? That's the $64,000 question that you want to know. And the answer is you got a better shot at it probably for your 475 ordinary income than you do for your capital gains. But don't panic over this, because if it's not business income, hopefully it's going to be investment income, which has great lower preferential rates too. In fact, under the Trump plan, it could even be better than the business rate. Now, before we get into that, let's continue with the business rate. What's the TRP's impact on the TTS trader S Corp? A lot of our clients, they're single, married, they have a single member or spousal member LLC S Corp. That's a preferred entity of choice under current law for arranging the health insurance, the health savings account, the retirement plan deductions. The S Corp pays the owner-employee officer's compensation, respecting what the Trump tax cuts are going to want, to support the employee benefits. TRP may favor this entity, an employee benefit solution, So it may say everything you're doing still works great, and the icing on the cake is whatever's left after the compensation, the net income of the entity is going to have the lower business income rate or the lower investment income rate. So, okay, is it business or is it investment? It should be one or the other. I don't think we're going to end up as an outlier in a third camp. Now, it is a little hard to believe that they're going to include short-term capital gains in investment income, and that's what they've indicated in the proposals. But it is possible when this all goes down that the trading income is not business income. It doesn't get the exclusion, the lower rate, one or the other on investment income, and you just really can't tap into that part of the Republican tax cuts. I call it that because the Democrats are not supporting it. They think it's a giveaway to big business and wealthy people at the expense of poor people. and middle class. So all is not lost. Even if that happens where your short-term capital gains can't navigate into the business income or the investment income lower rates, don't forget the Republicans are lowering tax rates across the board. So, and you don't really have investment expenses if you have trader tax status, so you're still going to do better with the Trump tax cuts. So I don't want to promise you something now that may not work out. To me, I think there's a good risk that the trading income won't qualify for a special rate. If it does, great. It doesn't change our planning for going for the gusto with the entities for 2017. And that's really important because you don't want to freeze your tax plans. TRP, impact on the TTS dual entity solution. This is the answer. If they say, no, it's not business income because it's trading gains, and it's not investment income because it's short-term capital gains, our answer is, I'm still getting the Trump tax cuts because I can have the dual entity scheme solution. Scheme is when it's inappropriate. Solution is when it's done right. Where the management company has management fee revenue. So the dual entity solution for TTS traders includes a trading partnership and a C Corp management company for arranging health insurance, health reimbursement accounts, and retirement plan deductions. That I just wrote the blog post today on the health reimbursement accounts. They're great. Check that out. TRP may favor a C Corp management company over a TTS trader S Corp because the management fee income received by the C Corp from the trading partnership, that's business revenues, and that should qualify for the business rate. So in that case, the dual entity solution may become the preferred solution for traders. It is already for traders that live in high tax states with a taxi S Corp like California, Illinois, and New York City. Now, will trading income qualify for a lower rate or exclusion? So far, I'm telling you, if they try to knock us out, I got to wait a back door to get back in. Now, let's talk about the trading income, the investment income preferential rate. Under current law, there is a lower capital gains rate on long-term capital gains held a year and on qualified dividends. The capital gains bracket is 0%, 15%, and 20%. It's fantastic. The two lowest brackets, 0%. But traders don't really hold positions for a year, so they don't get long-term capital gains. Now, TRP seems to include all investment income. Too good to be true. Interest income, for sure. They said interest income. They don't want just qualified dividends. It seems to include all dividends, not just qualified dividends where you hold on to the stock for 60 days. And this is the big one. They don't spell it out, short-term capital gains. They just say capital gains. And I think they really meant long-term gains. But I've asked plenty of other tax writers, and they think it's all capital gains. The House TRP uses a 50% exclusion, the old rules back in the day, rather than a lower rate. Trump uses the lower rate. It comes out about the same. And it might be simpler to just have the one rate with the exclusion. The House really wants that tax simplification with complex tax reform. Will Section 1256-60-40 treatment remain? Section 1256 contracts have 60-40 treatment, 60% long-term capital gains, 40% short-term capital gains. If TRP treats short-term and long-term capital gains the same, then 60-40 rates become irrelevant. Let's see if they do treat it the same. If they do, 60-40 is irrelevant. But still, 1256 uses MTM, and they'll probably keep that, and as I pointed out before, probably expand MTM to derivatives. TRP is tax simplification. TRP repeals many tax expenditures and loopholes to offset the loss of revenue from lowering tax rates. And this is the biggest issue, folks. If this bill blows, if the CBO says it blows a big hole in the deficit, that it's not revenue neutral, that there's tremendous giveaway in taxes and nothing is offset. It's going to be politically hard to pass. And that's what they mean with simplification. You lower the rates to get a broader base, but then you take away a lot of expenditures, which they means really deductions and loopholes. So they repeal a lot of code sections. They replace them with one-size-fits-all law. Like if you have full expensing, you don't have to worry about all these complex depreciation rules, amortization rules, depletion rules, cost recovery. TRP also repeals many itemized deductions, which are below the line. Those are after adjusted gross income. Now, business expenses are above the line. So TRP repeals most itemized deductions, except charity and mortgage interest. A lot of these lobbyists, special interest groups, are going to fight this out. It's going to be tough to get this done. For example, they repeal state and local taxes. A lot of the Democratic blue states cried foul over that. It's going to impact traders living in the high tax states. Now, AMT has reduced those benefits in the past, but there hasn't been anyone crying over this. It repeals miscellaneous itemized deductions. There's no miscellaneous lobby, but included in that is investment expenses. Investment interest expenses is separate from miscellaneous itemized deductions. Now, to replace the repeal of itemized deductions, they double the standard deduction. Maybe it won't end up double. It might end up much higher. So a lot more people will take a standard deduction. They won't bother with the itemizing. So they may not give a lot to charity, figuring it doesn't do me any good. I'm allowed to deduct it, but I'll never get over the standard deduction. So believe it or not, the charity industry is upset about that. And they don't want to get rid of the mortgage deduction because it holds up the real estate industry, which is a big factor in the U.S. TRP repeals investment expense and investment interest deductions. Under current law, investors, including traders not eligible for trader tax status, they deduct investment expenses on Schedule A. Investment interest expense is deductible if it exceeds investment income. Otherwise, it's a carryover. That's going to be repealed. Your carryover, gone. Investment expenses are miscellaneous itemized deductions limited to a 10% income threshold, and then AMT can knock away at it, or doesn't allow it, rather. So there's no deduction at all. If you make, if your AGI is 100,000, the first 10,000 is gone. TRP will have an impact on hedge funds. President Trump campaigned on repealing carried interest, profit allocation, and investment partnerships, so they would reclassify capital gain allocations to incentive fees. Instead of your investors giving you 20% of their capital gains, they'll keep their entire capital gain and they'll pay you a fee. But without trader tax status, that's an investment expense, and they won't get a deduction. So a lot of them are going to think the hedge fund got all of a sudden a lot more expensive. They're not getting much benefit without carried interest. Now, it's going to make hedge funds more interested in qualifying for trader tax status. That solves the problem. Now, those are the negatives, but there's also some positives. Lowering tax rates on short-term capital gains, if that's in fact true, and I still think it's too good to be true, and lowering it on interest income, that helps everyone, and just lowering tax rates overall. So there's positive and some negative. TRP favors TTS traders over investors. Tax law has always favored TTS traders over investors, and I think that gulf, that relative comparison, will only increase. TRP favors business expense treatment, even improving on current law. TRP repeals investment expenses. TRP makes TTS even more paramount for deducting expenses. Overall, TRP is good for investors. It promises lower income tax rates on ordinary income. It promises a preferential tax rate on investment income, including all capital gains, interest, and dividend income. That's a vast improvement if it includes short-term capital gains. And many investors don't have significant investment expenses, so repealing that doesn't hurt them that much. What's the fate of Obamacare taxes? Hopefully we'll see the Senate bill tomorrow. That should be very interesting. The House bill repeals all Obamacare taxes. But the Senate version, let's see what happens. Let's see if they retain some. I've seen different reports. The Obamacare 3.8% net investment tax is of most interest to traders and investors. That applies to upper income individuals with net income and modified adjusted gross income exceeding 200,000 single, 250K married, 125K married filing separate. Your married AGI is 300. Your threshold is 250, so 50,000 is over the threshold. And your investment income is 40,000, so you paid on the 40. If it's 60, you paid on the 50. That's a big chunk of money. That's a real shock for upper income folks. They will really appreciate a repeal or reduction of NIT. Let's see what the Senate does. Hopefully they still repeal NIT. Now, what's my forecast of TRP? The House prefers a comprehensive tax reform law. Speaker Ryan just said that yesterday, including tax on imports, the border adjustment tax. He didn't really talk about that too much yesterday. President Trump, Senate Republicans, Democrats, and many industries, including retail, don't support BAT, and the House seems to be walking that back. But BAT is the big revenue raiser, folks, paying for all these tax cuts. Now, President Trump wants tax cuts for corporations and rich individuals. He doesn't really need comprehensive tax reform. Ryan wants that. President Trump just wants to make corporations competitive. He wants jobs in America. And Chairman Ryan figured his import tax would bring jobs to America. But it's so revolutionary that it may be biting off too much. So Trump, he's not going to want the political heat for cutting taxes for the wealthy while cutting spending on the poor. And Schumer is going to fry him over that when they go to raise the deficit, the debt ceiling. He's going to say, I'm not raising the debt ceiling for you to have rich people tax cuts for the wealthy. In my opinion, there seem to be many vast gulfs for finding consensus on tax reform, and it's hard to make tax reform revenue neutral without BAT. So this is still a tall task. They thought maybe healthcare would be easy. It's still going to be tough to do healthcare. Now, Congress might downsize TRP to tax cuts. Just lower rates, leave most of the code intact. That would mean no repeal of investment expenses, no changes to capital gains, 475, 1256, 988. Hey, lower rates are nice. Current law is good for traders, trader tax status, 475, no SE, payroll taxes on trading income, lower 60-40 rates, business expense treatment, employee benefits with an S-Corp. We're happy with the current law. TRP does not simplify taxes much for traders, so we don't need to root for Ryan's comprehensive reform. We just want to get the gusto. Now, what's the timing of all this? Without any Democratic support, Senate Republicans need to use a majority vote, which is currently only permitted in a budget reconciliation measure. That window of opportunity may be closing. As I understand it, shouldn't that be happening in September? I don't know. There's not always a window of opportunity to use the majority vote. They have to hang it on budget reconciliation. Otherwise, they need 60 votes to get cloture. Now, I don't know if they're going to do a nuclear option and change the rules for tax reform, or the Democrats would get hay out of that politically. The House and Senate have not proposed a detailed tax reform bill yet, and it will take a long time to debate it. Congress claims it must enact a health care law before doing tax reform, again, dealing with budget reconciliation. The Senate may vote on that before the July recess. It looks like that now, or maybe just after. They may work through August. Let's take them at their word. They're working hard to get it done this year. But the 2017 legislative calendar is getting shorter, and with so much to accomplish regarding deal-making on a tax law, TRP seems unlikely to be enacted in 2017. Tax writers still promise they will get it done this year. TRP or tax cuts may be more likely in early 2018, and then politics for the November 2018 midterm elections may become a factor in the debate. I suggest traders do 2017 tax planning based on current law. Don't freeze up. Do it based on current law with an eye out for the TRP changes as we discussed today. So talk to me about it. So I'll take a look to see if there's any questions. We only have 1 minute, probably not today. Come to greentradertax.com, give us a call, chat with us, and I'm going to not get to any questions today, Ken, so you can grab it back when you're ready, unless you saw one that you really want me to answer.
No, I didn't get questions in. So thanks so much for a great presentation, Bob. It's you're the go-to guy for trader taxes, and you did an outstanding job of outlining everything that is pending with the TRP and some of the upcoming news and tips and strategies. I wasn't even aware of that 60-day window on the dividend, that kind of thing. That's why it's good to get expert help and advice from Bob Green and his team at greentradertax.com. He's the go-to guy for trader taxes. I'm a client and wholeheartedly have no hesitation in recommending Bob Green as the guy to go to help you with your taxes, for advice, for company structuring, for tax returns, for everything you need related to trader taxes. So, Bob Green, you're the world's best. Thanks so much for being here. I appreciate it.
Thanks, Ken. Thanks, everyone. And good luck with your session now, Ken.
Hey, thanks so much. I always like working with the best people in the world. It's a real short list, and they really know their stuff, right? Things that, even with all the knowledge that we pick up over time, not aware of. So greentradertax.com, pick up his tax guide, contact his people. I do recommend them. I'm a client myself, and so I wholeheartedly recommend Bob Green and his team. Let us go ahead and get underway with my portion of tonight's presentation. As you may have seen me in CBS Market Watch, Money Show, TheStreet.com, Stocks and Commodities, the now sadly defunct Active Trader magazine, which I still miss, Equities.com. I'm a UCLA graduate, former corporate quality engineer and statistician for Ford. Live here in Colorado, where it's nice and peaceful. You may have seen me in Stocks and Commodities, appearing in CBS Market Watch since dinosaurs roamed the earth back in 2001. So been around for a long time. I'm also a featured speaker at the Money Show events as well, and I've been in many of the different industry events. Let's go ahead and jump into it tonight. What I want to cover for you is finding breakouts and gaps that are tradable. I'm going to switch to live charts here momentarily. I just wanted to show a couple of quick PowerPoints to get us up to speed, so we're all playing off the same sheet of music. Finding breakouts and gaps that are worth trading, the strongest patterns, and risk management and scaling. My favorite patterns are minor gap continuations, multi-day high breakouts, and entries following wide range charts. Let's take a look at some classic breakout charts from our current market and the difference between where these are at and where stocks that you may be following. We're going to look at stock and mainly stock swing and day trading charts today for our current markets. My wheelhouse is stocks in the $20 to $70 a share range. Those have superior volume and volatility, so I like those that have biggest trading ranges as opposed to penny stocks or small caps. This is my pick for the breakout chart of the week, ARMK, going all the way from 38 up to 41, so it's got a nice 3-point range. For day traders, and you know who you are, you got a need for speed, charts like this one make a little bit of sense, ESPR. If you're an experienced trader, these are what we live for as day traders, things that have a nice multi-point range. A lot of traders struggle. A lot of my clients, I get a lot of clients that I inherit from other places that kind of mislead people about penny stocks or small caps, and people blow up their accounts trading thousands of shares trying to scalp 10 or 20 cents. That has too much upfront risk. I'm a very risk-averse trader. I've been doing this since the 90s, and one of the things I found that really helps is have a go-to list of chart patterns with enough volatility to make it worth your while, right? So one of the things, for example, this is a chart today, ESPR. There's one in the news, Lazy Boy, LZB. That's not nearly as good for day trading, though, is it? It is a gap continuation. You may have seen my article in Stocks and Commodities on mean reversion day trading. That's where you get a gap or a breakout that runs up, it pulls back down to 50%. I used to call these 1, 2, 3 patterns, but the technical term is a mean reversion. It reverts to or pulls back to the X-bar mean region of this data set. It runs up, pulls back, and then continues on up. And so even if you miss the first breakout or the retracement or the pivot, there's also a second chance at a breakout trigger above the whole number here. Another quick tip, make sure that you're always using whole number support and resistance. I've mentioned this for many years, teaching thousands of traders how to day and swing trade off of whole numbers. 29 is classic support. It ran all the way up to 31. It pulled back to 30 and moved up to 32, like clockwork. One of the hallmarks of a good professional trading approach is one that is consistent, not with just cherry-picked charts and so forth like many of the educators use, but something that in statistics you'd call reliability and validity, and therefore it has consistency across multiple charts and multiple time frames. So my point is, when you're looking for always look for gaps to continue if the gap is less than 10% or so above the previous day's high. This closed at 27.50, so that is the delta is less than 10%, so it did indicate a buy. You have a small bullish cup, it ran up, pulled back, kept going on up. Throwing a dart at this pretty much anywhere on the way up would have been a good play today, and it used whole numbers. But you could have potentially made a lot more money trading an instrument like this that had a 7-point range. 35 whole numbers support, ran all the way to 42. I've trained so many thousands of traders how to avoid false breakouts, and one of the keys for success in that is never buy nines, or never buy anything with a 9 in it, because that looks expensive. Buying at 39 would have been stupid, right? I mean, unless you held it all day. But if you bought 39 or so, it just went sideways for hours today. Anything with a 90-cent in it, same thing, because often you'll see resistance at the whole number. Trading is a lot more about the math than the chart patterns. And I've said that for so many years because that's the truth. The chart is just a history, a historical diagram of price action, and it can be used to help filter what's worth trading. But ultimately, your unrealized P&L is what's the most important indicator. So when you're using these types of charts, it always helps to do tape reading, which again I've taught for nearly 2 decades. You're looking for price action to continue on up to, I'm kind of simulating the tape or after the market closed as I record this, but what you're looking for is how fast does price action break above whole numbers, right? It'd be good if I match the tape to the chart here. But what you'll find in tape reading, I'm just changing channels for a quick tip here for momentum trades. You're looking to see how fast price action is able to break north of each 10-cent increment, and if that's doing so on high volume with the block share size. That type of momentum indicator is a time-honored tradition. You may have even seen Jesse Livermore's classic Reminiscences of a Stock Operator talking about the patter of the tape. It's true, just even more so true today with electronic day trading than ever before. We do not use level 2 boxes anymore. My longtime colleague, the late Don Bright, who is the world's foremost expert on direct access order routing and trading from Bright Trading, Don passed a few years ago, but he even indicated that too, that after the decimalization of the stock market, a lot of the indicators like level 2 were not as useful anymore. And so that's why we rely solely upon price action. The more important metric, this is another kind of capturing thousands of real money trade experience here in 30 quick minutes. The more important pattern to look at on the chart is this point range. And those of you who also have a quantitative background will appreciate that. The point range is the more important determinant than the underlying chart pattern because the trade potential is marked out with that point range. I always pick on AT&T. Let's see if it never fails to disappoint. Actually, the AT&T was okay today. Usually AT&T is not such a good chart. Or the very large caps, you know, like Intel or Microsoft or whatnot, tend to not provide, here's Intel, the chip maker, tend to not provide good trading volatility. So those are not really worth trading. Similarly, the very cheap penny stocks and the low float under $10 pump and dump $3 or $4 stocks that may go up 20 cents also are not suitable for intraday trading because you have to absorb too much upfront risk trading at least 1,000 or 2 or 3 or 4 or 5,000 shares just to squeeze 10 or 20 cents out of it. I prefer a chart like this where I can do my standard anywhere from 100 to 300 shares and come out doing well with it, you know, if it's got plenty of volatility and range. So kind of starting off with a little intraday tip. Now we're going to jump into swing trades. And one of the things I think it'll help make it clearer for you is to look at our 90-day daily candlestick chart. One of my favorite patterns is to look for large candles near the right side, signifying increasing momentum at the right side of a bullish cup. And that's often likely to attract new buyers. So even if you miss the first breakout, often you'll get a second chance after a subsequent consolidation region and a move on up. Now we have a shooting star up there, which is a bearish reversal sign. And of course, learn about candles from my longtime colleague Steve Nissen. But the point is, that's a shooting star. So we obviously would not want to buy up at new highs. That's the voice of the East. The voice of the West is, thou shalt not buy nines. So I think it would be completely stupid to buy 49.50 because it's very likely to stall at 50 and drop and do a false breakout. So don't ever buy anything with a 9 in it. Go through dozens of charts and you'll see in the $20 to $50 share range, whenever something has a 9 in it, it will often stall at the decade value, like this did. See how it ran right up above the 9, false breakout, got in the newbies who didn't know that rule, and then stopped them out. Don't buy anything with a 9. Seek to sell within regions with a 9. Just like in intraday professional whole number trading, I like to look for buying and selling within whole numbers, right? So a quick writer downer for those of you who do intraday is buy the 20, and again, this does not work with the cheap penny stocks because they don't have enough range to make it worthwhile. So that's why another reason you shouldn't be trading low float under $10 stocks. These, however, make a lot of sense. You got a whole number support at 17, whole number resistance at 18. Put on your trade at a 2-day high, meaning today and yesterday. I always get that question. I mean, today and 2 prior days. No, at the aggregate 2-day high. So today and yesterday at 20 or 30 cents, whatever, slightly above the whole number as your entry, and have as it as an exit target around the 80-cent mark. And that's a good whole number range trade. Okay, so you get an above a 17, you sell right under the 18. You anticipate the stall and the reversal at the 18 ahead of time, and it's fine to collapse the trade with that. Similarly, it's a good idea to avoid 9s, and just like that approach was good for selling right under a whole number, look at the multiple of 10 value as a sell signal or sell region for swing trading charts. So for example, it's fine if you had bought, say, 45, 46 to be selling right now. With the thinking, and what I do is in the back of my mind, I always think, hey, I can always rebuy if it takes out new highs over, say, 50.50, right, 50.5. Again, not a trade recommendation, but that's how I trade, is I look for windows of opportunity with consistent charts, which are not going to be found in the cheap chart arena. And this is, something you can use in your directional options trades too, if you're looking for great candidates. One of the patterns that I've taught traders for decades now is wide range candle at the right side of a congestion or a bullish cup. Other educators have since copied that idea, but I originated it back in 1999. It's one of my favorite patterns. You get a wide range candle at the right side of a bullish cup, and you go long 50 cents or so above the high of that. And you can see this guy skyrocketed on up, a nice 45-degree angle classic breakout. One of the biggest challenges you'll have as a trader is trading without stops, which you should never do, or trading too large on just several instruments. You may have seen my recently posted Money Show video from the interview they did with me a few weeks ago in Vegas, and also in my articles I've published saying trade wide, not deep. And that just simply means you should trade multiple instruments. Instead of 2 or 3 that you're trading heavy share size on, I like to spread my risk around, so I'm trading a portfolio of maybe a dozen or 15 instruments with lighter share size. The benefit of that is it makes you less committed to any one position working out. I may say plant seeds and trade all of these 50 or 20 shares each just to get the party started and see if they're able to take out new highs if and when they break out above their current resistance areas, right? These are good breakout charts. The challenge is, how do you manage that in a way that makes sense? And you don't want it to become overly complicated, but you can't do it like an amateur, which is looking for a magic chart pattern or a magic special proprietary indicator, betting 1,000 shares and sticking your head in the sand and hoping for the best. What you want instead is a sensible, rules-based, well-thought-out breakout trading plan. So here we've got a bullish cup. I always teach people how to trade cups. You got a cup breakout. We didn't have a handle here. It just moved up nicely on a high volume. So even though likely you'd miss here, you could get in on a subsequent day for a move up, or even a subsequent day after here because it's still in an uptrend. This is Harley Davidson. There's HRB, gap continuation, another favorite pattern. IONS, another cup pattern breakout continuation. What you're always looking for as a trader, and this is something that one of my institutional clients told me about, he clued me into this back in the early 2000s, is you're looking for out charts or charts that are in play, charts that are outlier charts. And The way to see that is the height of the whole real body candle and price action. So if it's been lollygagging along, going up and up and up and up and up, and then schwang, a nice big breakout, you got another one right after that. Now it's alive. It's alive. It's running up, and we've got a large price action. What I don't like about this, though, is the volume is divergent. I'd prefer that if, say, the volume were up incline volume, so you got convergent increasing volume and increasing price. But it's still worth a shot because it's a nice breakout continuation that ran from 37 to 54. So a huge run in this guy. Bearish engulfing, so warning, Will Rogers, danger. So we park a trigger up at new highs, say over 17.5. You don't go in long if there's a bearish candle pattern. That's a no-no. But you do put it on the radar because it's been in an uptrend, and you just take a look at it for potential entry up at new highs, say 1760. Now, so much of my career has been taught teaching traders the charts to trade versus the ones to avoid. For example, the story stock of the week has been Whole Foods Markets, right? A nice big gap up on Amazon buyout rumor, and it's been going sideways ever since, but it ran up at the expense of Kroger's and Walmart and Costco, which are down. Kroger's is a much bigger sold off 30% drop, right? Going from 30 to 21 and then doing a little lift here. Whole number resistance. I will likely trade this myself. Again, not a trade recommendation, but just tell you what I'm going to do. If it gets over 23.5 for pivot, I really don't like pivots unless they are extreme. And something that's a 30% drop from 30 to 21, that's a bit extreme. I mean, is the impact of Amazon buying out Whole Foods really worth 30% of Kroger's capital, the P&L, the net allocation, the share price? Is it really worth that much? I don't know. The street seemed to not agree, and they lifted it up off the low. Now, you don't buy the first sign of a bounce because that's where traders get in trouble. I feel bad for anybody that bought here at, say, 26 and now it's down to 21. I didn't, and hopefully you didn't either. I like to wait for the pain to be extreme and then start to subside with some sign of buyers rolling back into this guy. So for a pivot play, that would be my pick of a pivot play of the week, would be Kroger's long if it does continue on up off its earlier lows. It went up 2 points from 21 to 23. Mean reversion, again, 50% retrace. Exit target would be roughly half of that price elasticity, which eyeballing it would be around 26. So the trade setup would be a long trigger 23.50, exit target, and again, I sell right under whole numbers, so 25.70, 25.80. So that would be the potential trade mapped out ahead of time. If it collapses and drops, I do not short overnight. I may day trade it short on a loss of the 22 if it gets down here and starts to collapse downwards. But for swing trading, a pivot might be in order. If you do trade cheap charts, they should go a little sort of a little something like this. I'm a longtime jazz musician. I play tenor sax because it's a lot of fun. But the point is, this goes a little something like this. If you do trade these cheap, horrible stocks, I've lost the most money on the cheap stocks, like trying to buy Borders and Blockbuster on bounces. That didn't work out. I learned what Q means, no shareholder value. Stop the madness. There's got to be a better way. The way is, if you do trade cheap instruments, make sure, like with people, they've got authenticity, integrity of trend strength. They are reliable day after day after day. They plot away, they do their work, they continue up. They're not these pop and drop one-hit wonder stocks. I get so many clients from the penny stock and small cap places where these guys lose thousands of dollars trying to follow some guru saying, it's running, it's to the moon. And so they go 1,000 or 2,000 shares long. Next thing they know, they're 1,500, $2,000 in the hole. And they say, what happened? It was a $3 stock. I thought it was going to run up because I saw all this stuff on the website saying I could make a fortune trading cheap stocks. Just say no. That's not the truth. The truth is trading's a lot tougher than it looks, and it's all about risk management and the numbers and the math. The chart patterns are part of that, but a much smaller part than you might think. Anyway, if you do trade, long story short, if you do trade cheap instruments, I like ones with consistent trends. I mean, it's got a 3-point run on a $7 to $10 stock. This is what I call an acceleration ramp. I always talk about this in my money show appearances. You got an acceleration ramp. I still wouldn't be going long unless it takes out a trigger at least 20 or 30 cents above the high to avoid a false breakout if it just goes up and then stalls and drops. Personally, again, not a trade reco, but I'd use 10, not a trade recommendation, I'd use 1080 as a long trigger. In the meantime, if it chops and drops, fine, let it. We stay away. Going from a steady uptrend to a sharper hockey stick breakout, that makes sense for a long up here. But you don't want to trade $10 stocks like most of them that are zigzag up and down chop, trying to guess at bounces, or it's starting to poke its head up, you go long and then it drags price back down, kicking and screaming. That's not how to trade. You want instruments that have reasonable consistency. And it's a lot like playing a musical scale, right? You know, you want something where the notes are fluid and continuous on the way up, right? Whether you're playing blues or bebop or classic jazz or whatever, you want it to be melodic and continue to run up. You don't want charts that are zigzag all over the place trying to, you know, my whole thing about, people ask me too, Ken, what do you think about stuff like Elliott waves and Fibonacci? I say pashoo, pshaw, you don't need that. All you need is a good strong chart and a star to steer it by. If you're trying to do Elliott wave analysis on this, why? It's going up. What else do you need? As well, this is a wave 1 and that's a wave 2, and maybe that's a way to, people have a specific favorite technical indicator. It's like people with a hammer, everything looks like a nail. Stop the madness. What you want is good, simple, strong, clean price action charts that looks like a piece of string tied tight in a 45-degree angle breakout. You know, people like myself or my colleague Harry Boxer, another great breakout trader, these are the kind of charts that make sense, that, you know, that are advocated, things that actually have some consistency and some underlying strength to them. So that makes sense, right? Those are the kind of charts that you want to look for. Weight Watchers going on a diet, bada bing. Obligatory false breakout. And where did it break out to? Just near the 29. Would a buying a 29 have been a good idea here? Not really. I mean, maybe unless you sweated it overnight and held it through the pullback, but buying a 9 is usually a bad idea because things will stall and drop off of 9s. Instead, wait for the breakout continuation. If you take a step back visually and look at these kind of chart patterns, do the math. How much money could you have made if you traded something like this? This is Weight Watchers. Went from 15 to 31. It's a side note, my wife, who's from Japan, often gets the Weight Watchers, I think, the frozen dinners, and they're pretty good, or something like that. Anyway, I digress. But the point is, look at this. So it went from 15 to 30. It doubled in 90 days with nary a peep, maybe a little peep there. But for the most part, a steady story of buyers coming into this guy without having to guess and him and hot, you know, Fibonacci extension. You know, the Fibonacci traders would say, okay, let's come up with the Fibonacci play, because if you saw that, and they make it all exotic and complicated and hard to understand, and who cares? All you want is price. I'm a price action guy. I buy high and I sell higher. That's what I do for a living. I like to trade good, strong, continuous price, and I scale in every 2 points or so on winning breakouts. You want to scale into your winners, starve the losers, feed the winners, and build a trade portfolio or a trade management approach that is refreshingly simple, candid, and makes a lot of sense. And, you know, and no, I do not sell any handy dandy. And instead of doing all this pesky thinking with your brain, buy my handy dandy indicator because it'll help you too make bajillions of dollars in this. No, that's a bunch of hogwash. Don't buy anybody's indicators. It's a bunch of BS. I've talked to a lot of indicator developers because a lot of the charting software companies have asked me if I'd put together scanners, but I talk to the developers and they say, what do you want? And I ask them how they normally develop it. It's kind of behind the scenes stuff the indicator educators don't want me to tell you guys, but often, virtually always, it's just a small derivation of an existing current indicator that's already out there. Like, well, instead of standard MACD settings, tweak the parameter by 3 or 4. And that's it. And that becomes their indicator that they sell for thousands of dollars. That's ridiculous. All you need as an indicator is your brain and your eyes and pattern recognition skills. You know, could you have made money with this chart? Hopefully you could have, right? This guy doubled 15 to 31. My case is closed, right? And everyone's talking about NVIDIA. It's too expensive now. It's over $100 a share. I was calling it long for my members back when it was in the 30s back in the day, but right now it's up at 160 a share. So stop the madness. Yes, it was a big runner, which is a great chart, 140 to 160. This is a 3-year chart. You can tighten down to a 2-year chart. Anyway, this guy ran from 40 to 160, so quadrupled, and may well still keep running on up. You know, I'm a Disney shareholder. I used to trade Disney back in the day when it was on its, seemed at the time, nearly unstoppable breakout run, right? And those rare occasional long-term multi-year runners are great to work with until they're not. Instead, I think it makes a lot more sense to focus your energy on charts that have 90-day charts that make sense, that when you drill down into a 15-day basis, it also shows new signs of life. So it's in context of a pre-existing uptrend is my point, right? Previous resistance becomes new support right near that 28 whole number, and it's off to the races we go. So my purpose in covering these charts is to teach you the types of charts and the very simple price action based approach that you may want to start taking. So the trading education industry is predicated on guys coming up with a bunch of hogwash, and they try and sell it to people, trying to make, well, what they do is they go cherry pick a chart, and then, for example, I could say, I don't know, where's the chart here? Let's do Weight Watchers. Let's say I'm going to come up with this Wednesday at 3 p.m. and this is kind of take it to extremes, but kind of a joke to say, let's say I've got a Wednesday indicator, and if you buy every Wednesday, you too could be a big winner in the stock market. This is how the indicator educators come up with stuff. And then they go and they find a chart that had been going up and say, see, on Wednesday, if you'd bought with my Wednesday indicator, you too could have been the next, it's a bunch of hogwash. I'm a former corporate statistician. I'm kind of a hard ass. I'm very skeptical. And I think that your biggest friend is caution with tight stops and strong charts, and then play multiple instruments that you're trading a handful, kind of a portfolio of instruments that really make sense up at new highs. So you spread your risk, you know what patterns to look for, and you don't need to rely upon special scanners or special indicators or special software. You just use a good professional charting software. I use eSignal, but I also use TradeStation and Ninja and Metastock. Any of the good major charting softwares, traders, don't blame the tools if you don't make a lot of money trading. It's almost always not the tool. It's your risk management or lack thereof that leads to your success or not as a trader. Kind of a near parting thought here. If you are concealing your trading expenses from your spouse and you know who you are, you might have a problem trading. I always ask this at my money show appearances. I say, how many of you, show of hands, have ever concealed a major trading loss from your spouse? And I get all these heads go down and nervous laughter and a few sheepish hands go up, and you guys know who you are. Stop that. Go back to paper trading. You have no business trading with margin unless you're a profitable trader. You have no business even trading live capital unless you can make it as a demo account, paper trading lion kind of thing, or paper trading tiger. If you can at least double a paper or demo account in a reasonable time frame, you should not be trading live capital. Why add insult to injury? So what you do is you practice. Like in software development, we call it beta testing or sandbox. You test out patterns that are repeatable and see what kind of consistency you get. And if you're hit and miss, that's fine. It may take you quite a few years to get to a place where you're more consistent in your entries and exits. I'm here to tell you one of the most important things you got to get right, and I've told so many thousands of traders this over the years, is this range is important. You don't want to trade, to put it in context, let me pick on AT&T again. AT&T, this only has like 38 to 41, so it's got barely 3 points of range to work with. So I don't care what you do with this chart, you're likely to lose. Kind of like going into a casino and doing anything other than playing poker against people that can't play well, you're going to lose. I won my first poker championship 6 years ago, and it was a great feeling. But anyway, you're always going to lose in a casino unless you do the one thing which you can actually win at, which would be, say, poker against less skilled opponents. Similarly, this is like going to a roulette wheel, and I don't care what you bet, you're going to lose money, right? So odds are. So you put the odds in your favor by not trading instruments with narrow trading ranges of only a few points. There's a point of diminishing return too if you don't trade instruments that are too expensive or ones that are too cheap. I like ones that are in the middle here, the $20, $30 share range. And you need a consistent trend and a wide trading range and a good approach that makes sense. So I hope that gets your appetite whetted for some of the things that you can start learning about. With your own personal trading action plan, figure out which entry patterns you're going to trade, set your stops, targets, and exit signals, figure out how it all works. I'm Ken Calhoun, Trade Mastery. Thanks so much for being here to all of you. For more, you can visit that. I've got a epic. Been doing these for years now. The Saturday Trading Week Ahead events. We got over 4,300 registered as of February, up to over 4,400 now. Anyway, every Saturday that's free from 10 to 10:20. Nice and short market forecast and a few hot charts. Every single Saturday. They're not recorded. This is being recorded. This will be on the YouTube channel later tonight, but these events are not recorded. Also, if you want to learn more, I've got downloadable courses at tradingvideos.com, and that forwards over to my Trade Mastery site. So on behalf of all of us here, thanks so much to my longtime colleague Bob Green from Green Trader Tax. Highly recommend Bob. He's the world's top expert on trader taxes. The go-to guy, you know, he's the number 1. So, and I've been a client of his too. He knows his stuff. He's extremely helpful and knows exactly what to do. So he's a great resource, and I am trademastery.com. So thanks to all of you for being here. Best wishes for success in the remainder of our hot summer, and you know, trade with passion, trade with small stops, and try and make as much money as you can while losing as little as you can along the way. So thanks to all of you for being here, and I will get the recording up to the YouTube video, and that will, if you're watching this on YouTube, never mind this, but for those of you watching this live, you will get a email from GoToWebinar with the YouTube link in it coming up by tomorrow morning, so watch for that. And thanks so much on behalf of both Bob Green from GreenTraderTax.com and myself, Ken Calhoun from TradeMastery.com. I wanted to sincerely thank you for your time, your energy, and your attention, and wish you the best. Goodbye, everybody.